My name is Brian Overby. I'm here to talk about the ultimate guide to selling covered calls inside the First Trade platform. I am the senior options analyst for Options Play, and this entire event will last about 45 minutes. Now, I do have my Q&A box open up, and if you have any questions, please do feel free to put them in the Q&A box. I might address most of them at the end of the show, but if I see something that applies to the slide that we're talking about, I will definitely address it. Ultimately, with today's presentation, we're going to be going through a short PowerPoint talking about what a covered call is, and then we're going to be using the options wizard inside the First Trade platform to talk about how to find optimal covered calls on stocks that you might want to trade on. Now, this is really part of a three-part series. Now, every other Wednesday, we do more education for First Trade and cover a lot of the things that are inside the First Trade platform. But what will happen is, all right, I'm getting a little bit of feedback. Testing 1 2, testing. Is there an echo in my voice? Echo. All right, Matt, you're hearing me just fine? So it sounds like might be on your end long. No, you're sounding good. Okay, I apologize. All right. Ooh, we were on a roll too. All right. So so ultimately, this is part of a three-part series. Ideally, they all three go together. In that we're going to look at some of the best tools that are in the options wizard of the First Trade platform is helping you pick covered calls. Looking to sell puts cash secured inside your account and picking out that and then combining the two, and that's something called the wheel strategy. So all three of these seminars kind of go hand in hand together, and this is the way I look at it. The ultimate guide to selling covered calls is really just part one of that entire strategy. So let's get to it. Let's jump right in. Before we get too far along, I have to let you know that there is important information here. If you are going to trade options, you do need to read the characteristics and risks of standardized options. It's available to you throughout the First Trade website. And also, we're going to be looking at real examples today. They're not meant to be a recommendation. Past performance is not a guarantee of future results. So let's jump right into a covered call. Now, I'm going to start. I see quite a few people already in the Q&A. Has anybody out there already done a covered call on a position? And maybe, I don't know, got assigned or not got assigned, or ever put that position on? And if you have, please let me know in the Q&A box. And yeah, okay, there's a few out here that have done covered call positions. So I'm going to start with just a very basic covered call. Now, what I find interesting is that I've been teaching options for 20 plus years, and XYZ was always my fictitious stock. And now it's an actual symbol, and it's actually not a bad symbol to do a covered call on. It's block trading. And because of this, I like to use XYZ, and we're going to actually look at a live example on stock XYZ using the First Trade platform. So here's the strategy. When I put this together, it was an actual fictitious stock, XYZ, trading at $60. Now, normally, we like to go out about 30 days on our covered call positions, and we'll talk a little bit about the timing of the trade, but it really comes down to how much premium you're going to receive for a certain period of time. Whereas when we're looking at covered calls using the platform, the thing that we're highlighting most is how much static return you receive for selling that call option relative to owning the stock outright. So by selling a call option, you are bringing in cash above and beyond any dividends that the stock might pay. Now, you own the stock, so if it does pay a dividend, you also get the dividend. But you're saying that if the stock goes up in price, we're willing to sell our stock at a higher price so we can get a capital gain on that, on the underlying stock. And then also, we're going to, for saying that we will sell it at a higher price, we receive cash now. So the way we like to look at that is you got static return. If the call doesn't get called away, how much premium did you receive, and what's that percentage over that time period? And then you have something that's called if called return. If the underlying stock actually gets called away and you actually reach the strike, how much did you make on the stock, and how much did you make including the actual premium that was received? So in this instance, we're buying 100 shares of XYZ at $60. We're going to sell a 30-day 62.5 strike call at $1. The net debit, or the net cost of this entire trade, if you were to put it all on as one trade, is $59. Now at expiration, if the stock is higher, we'll put it this way: stock can do one of three things, right? It can go up, it can stay the same, or it can go down. And if the stock is above that strike at 62.50, shares will get called away. You will sell your stock at that higher price. If that happens, you have a total gain of about 6%, which is if called return. You make $3.50 on that entire position, which is the $1 premium received from selling the call option, plus you own the stock at 60, you're going to sell it at $62.50. That's $2.50 appreciation on the stock. So the total, if called return, would be $3.50, or 6% higher from where the current stock is trading. And that's 30 days later. So that's a very solid rate of return over a 30-day period of time. And then we'll look at that on an annualized basis. What would that be at? But here's the one that really want to pay attention to. If I'm doing covered calls, I like to do covered calls on stocks, and this is, I'm going to probably introduce a little bit into volatility here, but we'd like to say some volatility and some probability. Now, the word volatility doesn't scare anybody, I hope, right? So I don't want extremely volatile stocks, because a covered call position will limit your upside, but you still own the stock, so you still have substantial downside. So if I'm doing a covered call position on extremely volatile stocks, I get all this risk of the volatility to the downside, and I have limited and upside potential, because I'm selling away my capital gains above and beyond the 62.50 strike. So if I look at it, if I do this trade, and I'm doing it on underlyings that we want to trade this on, and I always want to highlight that inside the first trade platform in the options wizard, is sometimes you will see a lot of volatility, and then you always want to look at, well, is there earnings? Why is that volatility there? What's going on with that underlying, and do I want to be in that? So I'd like to have something that has some volatility and some predictability. And I think like a stock, and when I say that, I always like to use an example of a stock like Apple. Apple is probably one of the largest owned positions at First Trade overall. Most, especially if you throw in the fact that almost every ETF owns Apple, that is an index-based ETF. All of these positions in Apple, you have some volatility and some predictability. It's definitely, Apple has gone from, it was 200 not that long ago, we're all the way up to 300, but you get a little bit of premium, but it's not too crazy, right? We're not talking about a stock like Micron Technology, which has gone through the roof. That's a tough one, and a great example. Cisco recently announced earnings, and they've beaten 18 quarters in a row. So the stock actually rewarded them for beating once again. But that's a lot of volatility and not a lot of predictability. So we'd like to find something in the middle. And by looking at the rate of return, the static return, you can kind of filter out some of that minutia. Okay, so XYZ, if it's below 62.50, stock was at 60 to start, let's say it stays at 60, we get to keep the premium of $1, and that's 1.6%. So if you think of that over a 30-day period, that is a solid dividend if the underlying stock paid a dividend. But we're just getting that for just saying that we're going to sell it. We're willing to sell our stock at a higher price. And then if it's below 59, you still own the stock. And keep that in mind, that if the stock continues on down, the risk here comes from owning the stock, not from the call option. You can always buy the call option back and sell the stock if you're worried about the losses that are accruing because you are a stock owner on the position. So accurate profit and loss graph at expiration. We bought stock at 60, unlimited upside, substantial downside. We sell the call. We bring in a good amount of premium, 1.6%. So we got a small pillow to land on if the underlying stock goes down. But ultimately, I'm not doing this as to protect myself. I'm looking to do a covered call position. If you're going to do it over and over again, looking to bring in static income if the stock doesn't move at all. Now, to get that income, we're going to give up some upside. They have the right to call our stock away from us at that $62.50 strike in that position. All right. So we're going to talk a little bit about time value, because time value does matter. And if I'm going to talk about an at-the-money option contract and the time decay of an at-the-money contract. Now, we are going to go, and I'm looking more so at the different days to expiration. But in this instance, we're going 90 days out. We're going to talk about a $3 at-the-money option contract. It could be a call, it could be a put. It doesn't necessarily matter in this instance because it's at the money. And we're going to pretend that the stock doesn't move at all over that expiration. And we're going to just look at what time value has been lost over that period, or what gain you might have on that position. Now, we have underlying stock here, and so this makes this a little bit easier, because if you're not going to have to do something if the stock gets called away, like they could just take our stock away from us. But time decay does actually increase as expiration approaches. And so in our instance, we started with a $3 option. If a 90-day option contract becomes a 60-day option contract, we lose 55 cents. So that would be trading for $2.45 on the 60-day option contract. Then when a 60-day option goes to a 30-day option, well, in that instance, from 60 to 30, we're going to lose 72 cents on that option contract. And then in the last 30 days, goes from 173 all the way down to 0. It's like, wham, my sled hit the tree. And you can gain that entire $1.73. And in particular, if you see on this graph, the last 10 days to expiration, you get a huge rate of time decay on the position. Now, the risk of that happening is if you're selling the shorter term options and the stock actually reaches that strike, there's not much you can do about that position. You're going to probably get called away. Hopefully you wanted to sell your stock at that strike price. But if that happens, that's all right. Just go back and put on a new position and move on again. But this is how the time decay works. Now, if we're looking at out of the money options, it's not going to be as egregious, if you will. And the reason why is that there's just not as much time premium. Right? In our instance, we're looking at a $3 option here on our graph, but we talked about selling an out of the money option that was trading for $1. So there's just not as much time premium to decay, but it still does decay at an accelerated rate as expiration approaches. And that's the one thing to pull from this slide. And as a matter of fact, you want to get fancy about it, options decay at the square root of time. So if you look at a Black-Scholes pricing model, you will see a bunch of square root signs in there. And it actually works pretty well if you're talking about just a standard 90-day option in a theoretical world. The square root of time thing actually works, trying to figure out how options will decay throughout the life of that option contract. All right, any questions on that? Nope, we're good so far. Now, we're going to look at the first trade option chain, and I'm going to highlight inside the chain very straightforward chains at first trade. And I like this. This isn't part of the options wizard. We're going to go to the options wizard and look at it. And we're going to look at some of the other features that are inside the first trade platform. But if we have XYZ stock, it's trading at $71.53. So I find it interesting that they chose basically XYZ is trading fairly close to where my XYZ example was on a fictitious stock. But the stock is now at $71.53. It's made a fairly strong move up. We're looking at the June 26th expiration, and these are all the different expirations that are available. On this side, we have calls. On this side, we have puts. We're going to highlight the 83 strike, and I'm going to show you where I got this from, but it's a 52 by 89. Now, the market's a little bit wide. The market is open. I just grabbed this today, right before we started here, to make sure that we had an accurate. But if I'm selling option contracts, it's just all about what type of premium I can get on the position. If I could fill this at 60 cents or 65 cents, somewhere in between the bid and ask, I just want to know what that percentage rate of return is on my position. But we should be able to get somewhere close to that. Even though the market's a little bit wide, we still got a fairly wide, a lot of open interest, a lot of interest market in that spread. A lot of people that are making markets and bidding on this. So we have the chance to fill somewhere in the middle. So let's go back, and I'm going to jump out here real quick, and we're going to run over to the first trade platform. And I'm going to start, we're going to come back in and look at the options wizard, but I want to start here on the covered call report. So quite simply, if I'm looking at doing covered calls on a position and I type in a stock like XYZ, and the covered call report along with the short put report on that underlying will actually give you some trading ideas. And it will show you where the implied volatility ranking is at, where it is relative to the stock on a normal basis. 22 means that you're on a little bit of the lower end of the curve, but it also says to me that there's probably not earnings involved. And we'll look at that too, but and it highlights it here, actually. I forgot about that. The earnings flag actually says that within this expiration date, by the 26th of June, there is no earnings date. So the earnings date is actually in August. Here it is, August 10th on XYZ. So do we want to sell option contracts around earnings? And that goes back to the statement that I first made. I like to look at options that have some volatility and some predictability, and that earnings adds unpredictability into the underlying stock. It's very hard to know exactly what's going to happen after earnings. I don't mind doing it if you realize that that is the case with the earnings report. If you realize that this is the type of risk that brings in. But then if we go back and we actually look at the profit and loss graph, realize also that you will participate in a gap down in the underlying stock, a big gap down, but you don't participate on the way up. But because of that, you receive more premium, which is created from the volatility. And once again, we'll come back and we'll look at that volatility and talk a little bit about it. So I specifically like XYZ here because there is no earnings. We have a decent amount of volatility. It's not at the very low end. It's not down in the 5 or 10% level. So we're a little bit towards medium. Medium would be 50% as far as the ranking is concerned. So we're not above 50% and we're not below 10%. We're right in the middle. So we're getting a decent amount of premium. Now, the annualized rate of return, if we pull in this position, is going to be about 10%. Distance to the strike is 15%. So I'm going to show you how to adjust some of these trades inside the options wizard. The annualized rate of return isn't high enough for me. I don't like this one as much because of that, but you can adjust inside the options wizard to try to get a higher annualized rate of return. Looking at about, in general, about the static rate or the raw return is 1%. If I'm going to do this on a, it's about, let me see how many days out we are talking here. On the June expiration, we are 36 days away. So it's almost 30. So you could do this about 12 times, right? Not quite. And that gives you the annualized rate of return. So if you're doing 1%, it's 36 days, not quite 30. It's not perfect. If it was a 30 days and you did 1% every month, you would annualized rate of return would be about 12% on that underlying. It turns out that it's a 9.5% based off of that premium received. If you every 36 days could sell that call option against it and bring in that income. Okay, any questions on that? So this is a very easy tool that you can set up inside the options trade platform. And like, let's put in Apple here. I'm going a little bit off the cuff, but let's see what it's suggesting for Apple. So Apple, we're looking at the same, the same position. It looks like we're still going a little bit further out of the money. Raw rate of return is about a 0.5%. So the annualized rate of return is about 5%. All right, let's go back. Let's pull up the options wizard. And I'll show you some of the tools that you can use to help find trades. But if I'm doing block trade and I want to do an income trade, I'm going to click on income. Do you own the shares of block? And we're going to say yes, that we do. So we have this position on in our account. We're not coming into the position where we got to buy the stock and sell the call. And what we'll suggest based off of the income settings inside the first trade options wizard, if you click on the income settings, you can do your desired time frame. I always like to stay in the shorter time frame with covered calls because of the time decay chart that I showed you. And we're going to say that the platform is going to select trades that are between 29 and 30 days. You can do medium, you can go a little bit further out. Depends on how hands-on you want to be. If you're willing to get a little bit slower rate of decay, but then you wouldn't have as many trades to try to do if you're trying to do this on a monthly or a bi-monthly basis every couple of months, you would go to the medium time frame. And then you could go out as the longer time frame. But you just set this as your default. You could be conservative, you could be aggressive. Now, if I go aggressive, it's going to pick option contracts that are a little bit closer to the strike. But in this instance, we're being conservative. Or I guess we could go in and we could hit optimal too. Optimal isn't a bad risk tolerance in this instance either. Optimal is going to bring it a little bit tighter in and increase the rate of return. So let's take it here and save that as our default. And then I'm going to click on trade. Okay, so this is the suggested trade on block to start with on the conservative basis on the short term, bringing in about 1% on the trade. Now, this is what I'm focusing on in this position. I hate that it pop-up keeps coming up, is the annualized versus the raw. If we were able to do this every 30 days, that would be our annualized trade, where, well, it's 23 days out in this instance, or the raw rate of return. What is the total actual rate of return on this position? And if you're doing covered calls as a strategy, and in particular, we get into the wheel situation, we're really not trying to make money on the stock as much as we are on the options. So we want to make sure that if we're selling this and we have the risk of owning the stock to the downside, that we are benefiting enough if the stock just stays where it's at. If I'm not getting enough premium from my call options and I have one stock that goes against me hard and I have this position that hurts me in that scenario, well, then if I do that position, I want to, then the losses are just too great to undertake. So if I'm not receiving enough premium on the positions that are doing well, I'm not getting a good enough rate of return overall on that position, then the strategy breaks down, right? And the options wizard tool can help you avoid that. All right, so let's hit trade. Modify is what I meant. And if I'm looking at the options grid here, it will give me different scenarios on which option contracts I might want to sell. So we're going shorter term, and this is where I would leave my settings between 20 and 39 days out. We know that here's the earnings date right here on that position. And if I click right now, it's suggesting the 78 strike call with the stock trading at 71. If here's the 81 strike call. So if the optimal call matches your income settings, right? This is optimal, and it's closer to where the stock is at. That means we're going to bring in more income. If we go aggressive, and I'm highlighting that on the screen. I think everybody can see that. Let me pull this down. And we go aggressive, well, it's going to suggest calls that are closer to where the stock is at, and you're going to bring in more premium. So I'm going to click this. Now let's focus on these numbers right here. And I'm going to try not to put my mouse over this so that it doesn't stop doing the learning pop-up, right? 2.6% on a 23-day option contract. If I'm looking at this trade, that is a really good amount of premium, saying that if the underlying stock reaches 75, you can call it away from me, 4 points higher at this point in time. So my annualized rate of return on that would be 50%. If those option contracts keep expiring worthless, I could make a potential 50% if the stock just stayed at 71 over the life of this option contract. And that number is going to be higher when you have a shorter term expiration. So we have the risk of it being called away, but I'm bringing in enough premium that if I have a position that goes against me, if I'm doing this on a regular basis, that I can offset some of those losses, as opposed to looking at the conservative valuation, where I'm only bringing in 73%, and on an annualized basis, we're looking at 12%. So this is how the covered call writer, and I'm going to pull up a list of covered calls here, can help you and help you make sure that you're staying true to your goal of doing this as a strategy inside your portfolio. Once again, we're going to combine it with selling some puts, and we're going to combine it with all of this and create the wheel strategy is ultimately our plan here. So in first trade, we have this. Optimal is kind of where I like. We're looking at 1.5%, giving ourselves some more upside, because now if the underlying stock goes up, our rate of return on the upside will increase, because we have the maximum we can make on XYZ is now going to 78 as opposed to 75. We have more potential capital gain, but I'm still bringing in a 26% rate of return on the stock if it doesn't move at all. And those are optimal numbers to me, that I'm going to get at least 1.5 to 2% on our shorter term option, bringing in an annualized return fairly close to 30%. That means if the stock doesn't move at all, and we do this every 23 days, we can make 30% in option, or 27%, I'll round up to 1, 27, I'll round up to the 7, 27% annualized on a stock that didn't move at all. And not to mention if the stock pays dividends, XYZ does not, and that's highlighted right here too. But this is staying in the optimal range inside my portfolio. Now, 1.5% is still good, but if I go out further and I look at, let's look at a little bit further out, the strike prices are going to change a little bit. The 80 call is going to be within that range, right? We're going to give ourselves a little bit more upside, because now we're talking 40 to 70 days out to expiration. So we're at 15 days out. But here's what's big. We're bringing in 3%, but on an annualized basis, we're only at 20% rate of return. So if we do this every 58 days, we're going to have a lower annualized rate of return, as opposed to doing this option contract every 23 days. Our annualized rate of return goes up to about 27. And these are the things that I want to concentrate on. I obviously need to pick stocks that aren't going to go down. That's still part of the portfolio. You still want to do it on bullish stocks. But you want to make sure that you're bringing in enough premium to make this strategy work for you. Now, if you're just selling a call because you want to get rid of the stock, it's the year end. Let's take it. Oh, Micron Technology would be a great example of that, right? The stock has came off a little bit. Let me bring it up. MU, and we're at the end of the year, and we need to alleviate some of our position, right? So let's go ahead and look at a 6-month chart, and we'll go wide on this. And look at this type of gain just over the last 6 months. Right here, it was at 200. We now see it at 700. It's maybe if you're trying to make sure that your portfolio isn't overweighted and you own Micron, maybe you want to sell Micron and buy something else in that industry or not. I don't want to get into the minutia here, but you're seeing it start to sell off a little bit. I don't mind selling an at-the-money call just to get rid of the underlying stock. That's a totally different vision on the trade. And if we look at this and we have the stock, Micron, you're going to get paid. First of all, the IV ranking is around 80. Earnings is 35 days away on Micron. So we don't want to go more, well, you could write it into earnings, but I'm going to avoid that date right here. Let's look at the shorter term option contract, 23 days away, and the stock is at 116. I'm going to modify, here's what I would do. Okay, this is going to help you pick decent annualized rate of returns and raw rates of return. If I was doing Micron and I just wanted to get rid of my stock, I can receive a lot of premium. I can get almost all the premium back that when it hit this high at 80 and it came all the way back down to the 117 level. Let's just look at selling like 120 strike call. See how much premium we can get going 23 days out. You're going to be able to get quite a bit. So you can bring in $6,350, $63.53, which is almost, well, let's say 800 minus, we'll call it 720. That's 80 points. Almost get that all back by just saying that in 23 days, I'm willing to sell my stock at 720. Totally different outlook. I'm using covered calls to reduce a position that I've had a big capital gain on. And nothing wrong with that. There's nothing wrong with that at all. But that's not what we're talking about here by using the option tools. But this is not a bad trade at all. As a matter of fact, I don't mind on a stock like Micron, and I'm going to get a little crazy here, saying I really do want to sell the stock. I do want to get rid of 100 shares of my Micron, and in my position, the way that I would approach Micron right now, if I had 200 shares, I might sell off one of them and keep 100, and hopefully the stock will continue on up, and that would be your ideal scenario. But I don't even mind going down, let's say to the 710, getting $68, and saying if it's above 710, go ahead and call the stock away. I'm selling an in-the-money call option. That's how bad I want to get rid of the stock. And I'm getting paid $6,810 on my 100 shares to sell that. I know, mind-blowing, right? But selling an in-the-money call on a stock like Micron that you don't mind getting rid of some shares because it's had such a big run-up, that's an okay position to me. I don't mind it. Okay? I want to emphasize that. So if we're looking at doing this as an actual strategy, and we're going to try to bring in income, XYZ stock to me, some volatility, some predictability, I usually would try to avoid the earnings. If I have an expiration where I'm going into earnings, I might not sell the call option against it. Don't mind doing that, but then you're just a little bit more active. But let's go in, let's go into ideas and let's go cover calls. So if you want the situation where we are looking at yield, looking at what happens on a annualized basis if we sell these call positions. This is how we are sorting the covered call strategy here. And we're clicking on yield. You can change it to, if you just want to look at IV rank, you want to sell some volatility premium, you're going to look at company name, at symbol. We're going to do it by yield, and that's the default on the yield. Also looking at bullish signs. So here we have a stock that has a bullish, okay, we got very liquid, has earnings, don't mind earnings. And you can actually adjust the rate of return. If I'm looking at an annualized rate of return, we'll say between 15 and 30%. I think that that's a solid one. We don't want to do the lower rates of return. We want to be at least at or greater than 30%. And so 30% is, to me, is the magic number. If I bought a stock in this marketplace, I'm hoping that I can return 30% on that stock, right? If not, then why don't I just buy the index? The annualized rate of return on an index over years and years and years has been around 10%. So I'm trying to do a little better. So by just doing this strategy, I'm hoping that if the stock doesn't move at all, I can make at least 30%. So I'm going to leave both of these in. And we're going to scroll down and we're going to look for some stocks. Now, Marvell, a little bit, this to me is, and I just know the stock, right? We're in the semiconductor space. The IV rank is a little bit high. Stock has made the run up, the same type of run up that we've seen in Micron. But in this scenario, we're getting almost too much of a rate of return. 3% annualized, 34% above and beyond, but it's a very volatile stock, 93. We got volatility, but not a ton of predictability, all right? Rivian is interesting. Rocket Labs, okay, so Rocket Labs is a mortgage company. They recently had a strong earnings report, and the stock reacted positively. Yeah, we still got a high IV ranking, but a little less liquid than like a Marvell. But let's scroll back this way. A little bit overextended, 200-day moving average, or a little bit overextended on that. But we obviously just set out a new high on Rocket Lab Corporation. And if we do this, 2.7% annualized, 37 days out, we're right within the 37 days. That's not bad. That's not bad at all. And we're right within that ranking level. It's an interesting in that it's a $131 stock. It's possible to buy the underlying, sell the call against that position, and we're still receiving. We have to at least get to 30%. So I'm going to highlight this: 15 to 30 and 30% and higher. And that's our annualized rate of return. We don't want to be down in this range if we're looking to do this. And here's the raw versus the annualized. Let's go back and look at a few more. The problem Dell was actually a real interesting underlying stock too, in the way that it's part of the issue on the covered call scenario that I've actually that's a real issue is that you got to buy 100 shares. So if you got a $243 stock, Dell has done really well. This is a stock that I would consider doing as on an annualized basis, the covered call trade. Some volatility, some predictability. They've really made headwinds in AI. Their last earnings report, the stock really took off, and you're getting 2.23% to go out 37 days, selling the the 300. Yeah, I was going to say, I thought that was a 325 strike call, going out 37 days, getting 2%, getting an annualized rate of return of 25. Solid. Once again, the IV rank is a little high. I mean, we're not having as much predictability, but I don't mind this on Dell. It's just that now it's at the 52-week low was at 106. Now it's at 244, so it's a little bit of an expensive underlying to trade. Let me see if I can find one that's a little bit more in the stock price. Rare earth, that might not be as liquid, but USA rare earth has been in the headlines recently. We got very, very liquid underlying, mildly bearish, longer term bullish, 2.68%, $22 stock, easy to buy 100 shares of it, and pulling in the 30% annualized rate of return, going out 37 days. That's simple. Trying to find underlying stocks that you might want to trade them on. And then you can obviously always just pick your own. Let me see what underlying. Let's look at MMM. 3M has been beaten up. 38 vol, $148 stock. Stock has came down from 147. Annualized rate of return on the 155 is 1%. That's a little bit low. A little bit low. We would have to get to the optimal, the aggressive 152. Going out 23 days. Well, here in this instance, if I'm a little bit low on this, either I go down to this strike and I click the 152, bring in some more premium. We're getting 1.5. We're getting close to that 30% annualized. Or we go out in time, right? So we're going to stay here. We're going to click this strike. We still get that 1.7, but it's 60 days. Yeah, we're not getting the annualized rate of return. So here's a great example. I think this turns out to be a great example. You're going up 5 points in strike. This is the optimal scenario, but it's 60 days out. So you're bringing 1.7% in premium, but you're not reaching your goal of 11%. And if this is a strategy, that's not a decent enough annualized rate of return, if that makes sense, right? So I would rather go this route and have the chances of it getting called away and end up with at least my goal on the annualized basis. Now, I don't need to get that annualized, but I need to stay within my strategy. I need to do covered calls with this in mind if I'm going to do this on a regular basis on a gaggle of securities, on a group of stocks. That every time I do it, I don't care necessarily what day's expiration or what strikes I'm selling, as long as these numbers are around 1.5% and that's around 30%. Because if the stock doesn't move at all, I want to at least get that rate of return. Markets goes down, obviously you can close the position out. Don't have any problem with that whatsoever. If we do the wheel strategy, we're just going to buy more. And that's ultimately using the cash secured put, which is going to be next week. Actually, we're going to be looking at the cash secured put. And that actually comes inside this whole position. If we hit no, we actually talk about the put, saying that you want to buy the stock. And we have the same type of scenario that's going on. So let's run back to the PowerPoint. And I want to cover probably my favorite slide here is things to think about. And if you have questions, this is time to put them into the Q&A box, and I'll try to address them. What is the ideal IV range? All right, Matt, that's a great question to start. All right. I think I kind of covered it, and it's in that IV ranking. To me, it really comes down to the rate of return, how much you're getting on a static return basis and on an if called return basis, if the underlying stock went up. But the static one is where I'm really focusing on premium. Now, the ideal area for me would be between 20 and 50 on the IV rank. You're getting, and once again, I keep going back to this phrase, you're getting some volatility with some predictability. Now, if you're trying to do this as a strategy, and at options play, a lot of times we'll put out daily plays, and if I'm going to sell a call or sell a spread, you can't avoid earnings because we're putting out trades every day. And if we do that, and you're doing the earnings, well, then that gets thrown out the window because earnings, you're going to be at the higher end of the range as far as the IV ranking is. But I like somewhere between 20 and 50 on that IV ranking. And to me, that is some volatility with some predictability. Let's go back and see if I hit that right on a stock like Apple. Apple's already announced earnings. Well, AC3M here is right at 38%, AAPL. Yeah, IV ranking is right at 38. So when in doubt, default to Apple. Little bit more volatility than an actual underlying. It's not, this strategy isn't horrible in the SPY either. If you want to focus on ETFs, but you're going to be at a lower end of the rank. But yeah, not bad. With vols up right now, we're looking at a 31% IV rank. You're going to have very liquid options. This isn't a bad time to do the strategy in the SPY. Hit income, not own the stock, 23 days out, optimal. Where are we at here on the stock? 78 or 59. Let's look at this one. So a little bit lower rates of return, and that will happen a little bit. You got a $700 stock, so $73,000 plus dollars to buy 100 shares of it. 23 days out. I'd want to do this on a 30-day out basis. You're bringing in, so with an index, you're going to have more predictability and less volatility. Because you have an index, you have 500 different stocks, so you're not going to quite get the same type of rate of return. So I guess a question would be, a very good question to debate, do I do this on Apple or do I do this on the SPY? Apple is a big part of the SPY. There's, it's a large part of the actual index. But 1%, I don't know. Let's try this one. 10% annualized, modify. I think what I would do here on the index is I would modify this, and I'm going to pull it in tighter. I'm going to go maybe 745. Or 7, where were we at? 752? Yeah, 45. I said that right. I'm just doing this off the cuff, right? So now we're 1.28%, saying that we're going to only give ourselves about 6% upside. But this is how you'd use the tool. 1.8% is close. It's almost that 1.5. We're doing 22.24, trying to pull in that income. 31% volatility. Everybody knows what the spiders are at, or SPY. Right now, because vols are high, we got the VIX probably around 18 or 19. And when that happens, in this instance, this isn't a bad rate of return to do it on an index like the SPY. But that's a simple one, right? If you want to get a little bit fancy, coming out and looking at different stocks inside here is a different way to look at it. All right. Let me hit mute for a second. All right. So now the questions are coming in. When I look at a stock, ACA, the options grid within the tool is incomplete. What does this mean? Within the tool, ACA. Oh, it means that there's strikes not available. If you click modify, this is going to set the incomes. If we're looking at here, right? If we're looking here, you're only going to get the risk tolerance in this level and this level. If you want to modify it and you want to look at the different strike prices, this is within the tool. This is the way that it works. This is the only way that you can adjust it to look at the different strikes. It shows you the one standard deviation. It shows you the delta inside here. Roderick, I think that covers it. All right, let me go back to the slide now. I wanted to cover this last slide and then we'll call it a day. So this is meant, things to think about is meant to be something that will bring up questions and allow you to address questions. Okay, would you have the same outcome on a percentage if you only bought the call without owning the stock? I'll just Treva. I'm sorry, my eyes are. No, you wouldn't. As a matter of fact, that buying a call outright is 100% different than doing a covered call. Buying a call outright, if you want to do it synthetically, it actually looks like buying the stock and buying a put. Because by buying the call outright, as opposed to buying 100 shares, you are having limited and known downside with unlimited upside, which is the exact opposite of the covered call. The covered call, you have substantial downside because you own the stock, and you have limited upside. But your break even is going down the x-axis, and it's at a lower price than where the current stock is at. So just flat out, if you're looking at buying the call outright, that's an alternative to owning the stock and having limited and known downside. And if you have very liquid underlying stocks like an Apple, buying a deep in the money call can act like owning the stock as a surrogate for the stock. But that's a totally different scenario. The exact opposite. Here we're trying to make, if we're doing the covered call strategy and everything that I talked about in the ultimate guide to covered call writing, we're talking about trying to make your gains on the premium of the option contract and the net credit that is received, as opposed to trying to make gains because you picked the right stock. You still want to get it right. You still want to get some upside on it. But we're looking at setting up the strategy that we bring in enough premium on every call that we sell that if the stock doesn't move at all, we still make a decent return on that stock because of the call option. All right, things to think about. Let's get through this slide and we'll call it a day. I'm going a little bit long here. Can you buy this as a covered call or a single trade as a buy rate? Most people you buy the stock and then you sell the call. You can enter this as a buy rate, but a lot of people don't do that. That means that I'm going to actually send it to the trading floor, buy 100 shares of Apple and sell this call, and I want to get it done for a net credit to the account. Most people just own the stock and sell the call. And part of the reason why is that when I bought the stock, I think it's going up. So why am I going to sell a call on it right away? But you can enter it that way. So this is more common. You buy the shares first and you sell later. What is the wheel strategy? I bring this just to kind of remind myself that we're going to talk about cash secured puts, meaning that you're selling a put with the cash, able to buy the stock at the strike. That's going to be the next step. And then the next step after that is the wheel strategy. So you sell puts on stocks that you want to buy. Stock comes down, you get the stock put to you. Then you sell a call to try to get rid of the stock on the upside. So you're bringing premium in on the way down, right, from selling the put option, and then also receiving premium on the way up by selling the call option. And that's what the wheel is. And that is taking the strategy to the on steroids to the nth degree, because now we're trying to bring in premium on both sides, on the initial purchase and on the actual sell. Where does the risk come from? Emphasize this a lot. It comes from the stock. It doesn't come from the option. You give up opportunity. You have an opportunity risk on the upside, but the stock is the risk. And always realize that if the stock's going down, you can buy the call back and sell the stock. The call will be at a lower price than what you sold it for, so you'll have a gain. But buy the call back first and then sell the stock. If you do it in that order, no worries. But if you try to sell the stock and you still got the call, the website, actually, firsttrade.com, will stop you and say you can't do this. This will leave you with an uncovered call position. Okay, so just make sure you do it in the right order. Are you locked into the position until expiration? I guess I just answered that. When is an assignment most likely to occur? So now this is something that we haven't addressed, and that is that if the stock does get in the money, you're not likely to be assigned right away. And the best way that I can explain that is you have to think of yourself as the call buyer. I bought the call because I didn't want to buy the stock and pay all the cash for the stock, right? The stock is now in the money. It was out of the money to start. Now it's in the money. And if I exercise the call, what do I do with cash? If I exercise the call, what do? I buy the stock, right? I spend a lot of cash because I got to buy the stock at the strike price. Do I want to buy cash now or spend cash now, or do I want to spend it at expiration, closer to the expiration date? Why not wait? If anything, if I still want the stock and I'm still in that position, well, I'm spending cash later, so I'm earning interest on the stock, and I'm also still in a limited risk asset because I got the long call. If you're just thinking about it on a 100 shares basis, I was going to buy 100 shares of stock, I bought a call as opposed to that. So most people are going to wait until closer to expiration to exercise. So sometimes that can be frustrating as a covered call writer because you want them to call the stock away from you, but be prepared that it might go in the money, not be called away, and then actually come back down out of the money. That's something that can happen. So you're most likely to get assigned to get your stock called away closer to the expiration date. What is the best expiration date? We covered a lot on that. Do you want to sell the shares? And if you want to sell the shares, it's a different strategy. And I went into that in great detail on the Micron situation. If I want to sell the shares, I don't mind selling something at the money or even in the money. It's okay to sell a call option in the money saying, go ahead and take it away. I really want you to take it away. Is too much premium, is that possible? Yeah, it is. Some volatility, some predictability. So that's where too much premium can come in. If you see a lot of premium, there's probably a reason. More than likely, it's an earnings report. That's the most obvious one. And if you want to do it around earnings, go ahead, but realize that you are getting yourself in a situation where you have limited upside, but you still have all the downside risk of owning the stock. And then also, not enough premium. Is that possible? Very, very true. Like you could look at some utility stocks, stuff like that. There's just not enough premium in it to make it enticing to do the covered call. That's where the 1.5% and the 30% annualized of the tool helps you out. You don't want to sell something where you're just not getting enough premium to make it worth your while. If you're doing this as a strategy and you're doing it monthly to bring in income on your covered call position. All right. I don't see any more questions. Some great questions, as always, when we're looking here on the First Trade platform. And that was if we got into volatility. So I'm going to go all the way back. And thank you for stopping in for the ultimate guide to selling covered calls. Brian Overby with Options Play. If you want to follow me on x.com, my handle is @BrianOverby. And thank First Trade for sponsoring this event. This is wonderful and great education, and they give you obviously some options tools to work with. Thanks for stopping in.